In this chapter, we are going to discuss sourcing or raising equity in global markets. There'll be quizzes to reinforce the concepts learned. Although these quizzes are optional, you'll benefit by taking them. Firms need capital to grow their business. A factory may be looking to expand, or a retail store may be looking to open another store. They all need to raise capital to meet their goals. The capital can be raised in the form of debt or equity. In this chapter, we are going to discuss the equity part, and in the next chapter, we'll discuss the debt part. Typically, companies raise equity in their own country, but it's possible for companies registered in developing markets to lower their cost of capital by accessing global capital markets. This is because the global markets widen the investor pool. A downside to raising capital in global markets is that firms need to comply with different accounting standards, which may be stricter than their home market standards and could therefore be costly. The most common method of raising equity in foreign markets is through depository receipts. Depository receipts work pretty much like stocks. They are issued against the domestic shares of the foreign company. For example, a Japanese company would surrender its domestic shares to a bank, and depository receipts will be issued against the Japanese shares. Depository shares are issued outside of the company's home market. In our example, they would be issued outside of Japan. There are two types of depository receipts: American Depository Receipts, or ADRs, and Global Depository Receipts, or GDRs. ADRs are issued in the United States in US dollars. GDRs are issued outside the United States and outside the home country of the issuing company. It's important to keep in mind that although GDRs are issued outside of the United States, they are commonly denominated in US dollars. GDRs are traded primarily at the following exchanges: London Stock Exchange, Luxembourg Stock Exchange, Hong Kong Stock Exchange, and Singapore Stock Exchange. The firm decides whether to issue ADRs or GDRs and what country to issue GDRs in. The firm will go where it is likely to be recognized the most. Investors in the United States would be eager to buy ADRs of well-known foreign companies like Alibaba of China, so these companies have ready access to international equity markets. However, investors would be reluctant to buy shares of smaller companies that they are not familiar with. These companies, therefore, would not have ready access to international markets. What do the smaller companies do then? Well, these smaller companies can take small steps. First, they can simply cross-list their shares without raising new capital. Once they are recognized, they can issue new shares to raise equity. Let's see how ADR cross-listing works. Assume we have a publicly traded firm outside the United States, and in our example, we're going to assume that this company is located in Japan. This company would take its Japanese shares and it would hand over those shares to a custodian bank in Japan. The custodian bank simply takes these shares for safekeeping purpose. Custodian bank is going to work with a depository bank in the United States. Bank of New York Mellon, Citibank, Chase, these are the depository banks that work in the United States with custodian banks. The depository bank in the United States is going to issue ADRs against the Japanese shares. These ADRs will be traded on NASDAQ or New York Stock Exchange, and the company's local shares would be traded at the Tokyo Stock Exchange. Now, this creates an arbitrage possibility. People can buy shares on one exchange and sell it on another exchange. Cross listing can be the first step in raising new capital, but there are other reasons why companies cross list their shares. First, with more buyers and sellers, the demand and supply of these shares is likely to be more in balance. This improves liquidity of the company's existing shares. With more buyers and sellers, especially in the developed markets, the shares are likely to be fairly priced. To increase the firm's visibility among its buyers, suppliers, and customers. The company can also use the ADRs for making acquisitions in the United States. Finally, the company can use the ADRs to provide managers in the United States as an incentive for better performance. Why would investors be interested in buying ADRs? First of all, currency conversion is done at the institutional level, not at a retail level. In other words, investors don't have to worry about converting the currencies on their own. And when the currency is converted at the institutional level, they get better exchange rates as well. Second, dividends are received in US dollars as well. Tax withholding is simpler. The tax withholding is done by the depository bank, which is located in the United States. Ownership is transferred in the United States. When an investor dies, the transfer of ownership is done in the United States, which is a fairly smooth process. Settlement is done in the United States and is much simpler as well. So after buying and selling ADRs, the settlement process also takes place in the United States. ADRs provide liquidity for the companies as well as for the investors. They can buy and sell ADRs just like a common stock. Investing in direct shares can be risky and a complex process. You have to understand the rules of the other country where you're investing. You have to know that country's language. So there are a lot of barriers in investing in the other country, in a foreign country, directly. And with ADRs, the financial statements are in English. So that's another incentive for US investors to buy ADRs. Let's take a look at an example of risks involved when investing in foreign equities. Let's say that a US portfolio manager invests $1 million in Japanese equities when the spot rate is 100 yen per dollar. So the portfolio manager is going to convert $1 million into yen at the rate of 100 yen per dollar. A year later, the manager liquidates the portfolio, that means sells the investments, and at that time, the spot rate is 105 per US dollar, which means the dollar has strengthened and the yen has weakened. The portfolio has lost 4% of its value over the year, but the portfolio also received 1 million yen in dividends. So, what is the gain or loss on this investment? First, the manager converts $1 million to yen and receives 100 million yen to invest. The manager liquidates the portfolio at 4% loss, and therefore the manager is going to receive 96 million yen. That represents a loss of 4% on 100 million yen. And there is going to be 1 million yen received in dividends. So the total amount the manager receives upon liquidation is 96 million yen plus 1 million yen in dividends, and that equals 97 million yen. The manager is going to convert the 97 million yen to dollars at the rate of 105 per US dollars, and that amount equals $923,810. So the manager went in with 1 million and got out with $923,810. So they lost 76,190 or 7.62%. Although the portfolio lost only 4%, the total return or the dollar cost of investments was negative 7.62% because the yen also declined. So here the first risk is the portfolio itself declined, and another risk is that the currency also declined. So there's a double decline, and therefore there is a loss of 7.62%. ADR types. There are two types of ADRs. ADRs could be sponsored ADRs or unsponsored ADRs. Sponsored ADRs are created at the request of the underlying foreign company. In our example, we looked at the Japanese company. So let's say the Japanese company wants to get listed in the United States. The company will initiate the process of sponsored ADRs, and the company will pay all the costs that are associated with listing the ADRs. Unsponsored ADRs are created at the request of US investors, and the foreign company does not even get involved in the process. US investors pay the listing cost. So let's take a look at an example of the process of how sponsored ADRs are created. On the left, we have the United States market, and on the right, we have the Japanese market. The Japanese firm decides that it wants to have its ADRs created. So in step one, the Japanese firm is going to sign a contract with the depository bank in the United States. So the depository bank, as a part of its contract with the Japanese firm, is going to withhold taxes for US investors, is going to pay out dividends on behalf of the company, is going to send out all kind of communication to investors. So everything that needs to be communicated to investors, all investor related services are provided by the depository bank in the United States. In step number two, the Japanese firm delivers its local shares or the Japanese shares to the custodian bank, which is located in Japan, and the custodian bank is going to safekeep the local shares. In step number three, the custodian bank informs the depository bank that it has received the shares of the Japanese firm. Step number four, the depository bank creates ADRs and registers them with Depository Trust Corporation or the DTC. And they have to be registered with the DTC because all the settlement of shares goes through the DTC. Step number five, the depository bank delivers shares to New York or the United States brokers. And in step number 6, the brokers sell the shares to investors, and the shares get traded either on the New York Stock Exchange, NASDAQ, or over the counter market. So that completes the cycle. Let's see how unsponsored ADRs are issued. Again, we have the US market on the left and the Japanese market on the right. Here, the United States investor places a buy order for the Japanese firm, and this order is placed with a New York broker. And step number 2, the broker elects to create ADRs and contacts the depository bank. Step number 3, the depository bank instructs custodian bank to buy local shares. So the custodian bank would go to the local stock exchange, in this case, the Tokyo Stock Exchange, and would buy the shares of the Japanese firm. In step number 5, the custodian bank informs the depository bank that it has purchased the shares of the Japanese firm in local market. Notice so far, the Japanese firm is not involved at all in the process. In step number 6, the depository bank issues new ADRs and registers them with the Depository Trust Corporation. Step number 7, the depository bank delivers those ADRs to the United States brokers. The US brokers sell those shares to investors, and thus a buy order is completed in step number 8. These shares are traded only over the counter. They are not traded on the New York Stock Exchange or NASDAQ. And now the process is complete, and we see here that the Japanese firm is not involved in the process at all. Can the firm be sued for some reason by US investors, although the firm did not initiate the process or did not participate in the process at all? And the answer is yes. In the United States, the firm can be sued. So in order to protect them, firms would have to place a disclaimer on their website. And here we see this German firm, ThyssenKrupp, has a disclaimer. And as you can see, the highlighted part says that ThyssenKrupp AG does not support or encourage the creation of unsponsored ADR facilities in respect of its securities, and in any event disclaims any liability in connection with an unsponsored ADR. And if you have not heard of this company, next time you get on an escalator or get into an elevator, look around, the chances are you'll find this company's name, that those escalators or elevators were made by this company. The next topic we're going to talk about is private placement under SEC Rule 144A. Companies can issue shares, or ADRs rather. Foreign companies can issue ADRs for private placement under SEC Rule 144A. These shares are not offered to general public. Only qualified institutional buyers or QIBs can participate in these offerings. And the advantage to the issuer is that they're able to raise capital very quickly because they don't have to file too many papers. And the investors here, the qualified institutional buyers, are supposed to be sophisticated investors. And that is the reason why the issuer doesn't have to file too many papers. So the process is much quicker, and the issuer is able to raise capital quickly. But the problem is, since the trading can occur only between the qualified institutional buyers, there is lack of liquidity. There are not too many people willing to buy or sell these shares. Let's take a look at ADR characteristics by sponsorship type. When it comes to ADRs, there are different sponsorship levels. The lower the sponsorship level, the easier it is to issue ADR under that level. So let's do some comparison of different types of sponsorship levels. Of course, the first one is unsponsored that we just talked about. Then we have level 1 sponsorship, level 2 sponsorship, level 3 sponsorship, and sponsorship under the SEC Rule 144A that we just talked about for private placement. As far as the trading is concerned, unsponsored ADRs are traded over the counter, and level 1 ADRs are also traded over the counter, but the pricing is also provided on pink sheets. Level 2 ADRs are traded on the New York Stock Exchange or NASDAQ, and same applies to level 3 ADRs. Whereas under the SEC Rule 144A, the trading occurs on a platform known as Portal, which stands for Private Offerings, Resales, and Trading through Automated Linkages. As far as the accounting standards are concerned, under unsponsored ADRs, only home country standards need to be met, and same thing applies to level 1. But for level 2 and level 3, the United States generally accepted accounting principles have to be met. And for SEC Rule 144A, the home country standards apply as well. So level 2 and level 3 are more difficult to comply with for many firms in developing markets because the accounting standards are stricter and it could be costly to meet those accounting standards. As far as the SEC registration is concerned, the unsponsored and level 1 ADRs as well as Rule 144A ADRs are all exempt from SEC registration, whereas level 2 and level 3 ADRs require full SEC registration. Again, that is costly. Offering type, unsponsored ADRs is a public offering, and so is level 1, level 2, and level 3. They're all public offerings. The difference being that under level 3, you're able to raise new capital. Under SEC Rule 144A, as we discussed before, is a private offering to qualified institutional buyers, and new capital can be raised. So there are two sponsorship types that allow you to raise capital, level 3 and SEC Rule 144A. But SEC Rule 144A is offered only to qualified institutional buyers. And there are about 2,600 qualified institutional buyers in the United States. With regards to time to completion under unsponsored ADRs, it varies. Would be somewhat similar to level 1 ADRs. Time that it takes to complete the level 1 ADR process is 10 weeks. For level 2, also 10 weeks. For level 3, 14 weeks because new capital has to be raised. And under SEC Rule 144A, takes only 16 days because, as we said before, it's being offered to, the ADRs are being offered to sophisticated investors who are registered as being QIBs. And you have to have at least $100 million of money to manage to be able to register as a QIB. As far as the costs are concerned, under unsponsored ADRs, there is no cost to the issuer. Under level 1 ADR, the cost is $25,000 or less. Level 2 is $200,000 to $700,000. And under level 3, the cost could range from $500,000 to $2 million. And under the SEC Rule 144A, the cost could range from $250,000 to $500,000. The advantage of unsponsored ADR is that it satisfies investor demand. Level 1 offers an advantage that the disclosure cost is low. Level 2, there is a high visibility and liquidity. Level it offers maximum visibility and maximum liquidity. Under SEC Rule 144A, the new capital can be raised very quickly. That's the advantage of SEC Rule 144A ADRs. But there are some disadvantages of these ADRs as well. Unsponsored ADRs do not provide liquidity, or there is a lack of liquidity and transparency because accounting standards are home country standards. Under sponsorship level 1, the liquidity is limited and you cannot raise new capital. Under sponsorship level 2, it is costly. It requires full SEC disclosure, and again, you cannot raise any new capital. Under level 3, the disadvantage is that it's costly. It requires full SEC disclosure, and under SEC Rule 144A, there is lack of liquidity and transparency. Here are some of the examples of ADRs under each category. Under unsponsored ADRs, ASICS, which is a Japanese firm, its shares were used to issue unsponsored ADRs in March of 2014. Under level 1, Qantas Airways of Australia, under sponsorship level 1, ADRs of Qantas Air of Australia were created in February of 2014. And notice the 1-to-10 ratio. That means 10 local shares were used to create one ADR. And why is that? One of the reasons being that their local shares might have been in the price range of $2 or $3 and $4. So when you combine 10 of them to make one ADR, the price becomes $20, $30, or $40 or $50, and which is the trading range that is common in the United States. If share of $2 is issued in the United States, investors in the United States may not value that share that much. Under sponsorship level 2, XLT Bio of Israel issued shares in July of 2013, and the ratio was 1-to-20. That means 20 Israeli shares were used to create one ADR. Under level 3, Greek company called Navios issued shares in January of 2014. And here the ratio was 100-to-1. That means one share was split into 100 ADRs, and these were preferred shares of Navios. And the company raised $50 million. Under SEC Rule 144A, Far East Investment Bank offered shares in January of 2014 and raised $135 million. This company is from Taiwan, and 20 local shares were combined to create one ADR. Then there are Euro equity issues. A company issuing equity in multiple countries outside of the home country simultaneously is issuing a euro equity. So, for example, a company in Hong Kong issues shares on the London Stock Exchange and New York Stock Exchange simultaneously, then that issue would be known as a euro equity issue. Euro prefix meaning outside of the home country. And here we have a GDR example. China Steel Corporation announced in 2011 to issue GDRs. And as you can see, highlighted in yellow here, the company was going to issue 37.8 million GDRs and wanted to raise 743.53 million US dollars. So although this is a GDR, it's denominated in dollars. Okay? And 20 local shares would represent one GDR. So the price roughly of local shares was $1. And when you combine 20 of them, you get a price of $20. Here we have $19.67. So approximately the price was $1. And you can see, as it is highlighted in purple, these GDRs would be traded on the Luxembourg Stock Exchange. And we said this is one of the stock exchanges for GDRs. So in summary, companies raise capital in international markets using depository receipts. American depository receipts are issued in the United States. Global depository receipts are issued outside of the US and outside of the home country and commonly denominated in US dollars. And there are various levels of ADR sponsorships.